We're joining today for a gentleman named Dirk Armbrust, who works with a good friend of mine, Alex Vantacaris, owns the Vant Company. I've known Alex for several years. He and I are members of the same church, been to his Bible studies, and thoroughly enjoy a quality person. So we've used him on clients for ourselves. In fact, is in the middle of one right now that's going out for roughly 60 million. We have bids up to 60 million on the transaction right now. And that is the reason for us talking today is what do we need to do to get ready? And I'll tell you that every potential client I have, day one, first conversation, I discuss that your company's for sale. If not today, a year from today, 5 years from today, or when you get in your car today and an event happens and you don't make it home like you should. So you need to be prepared and run your company like it's for sale every single day. So with that, I'm going to be introducing Dirk Armbrust, and with the Vant companies. The subject matter today is discovering the keys to building generational wealth. All of that starts with today's wealth. So with that, Dirk, why don't you introduce yourself and share some of your background and why you're the person that's on here today.
Okay, you bet. Thanks so much for having me, and it's good to see everybody this fine rainy morning here. And I'm actually dialing in from Central Texas, so I think y'all got the rain last night, and it's here now. So I've been with the Vant Group since about 2015. I'm a M&A advisor. I do M&A work for people preparing their companies to sell, helping to get through the successful sale process. In the first half of my career, I was an operator. Ran 127 11 stores in Dallas, Fort Worth, for example. I'm a Air Force veteran, went to the Air Force Academy undergrad, did some time in the Middle East, kind of between the wars. So I was one of the lucky ones. So thanks for having me.
Absolutely. Well, the subject today is your choices matter, how you manage your time, your assets. You're growing your generational wealth, or you're using it all up or losing it potentially. So what do you do in the tough times by sharing knowledge and resource and trying to put all of this together to make a solid company, growing a solid company, and creating that generational wealth? So what do you do? And then from there, we'll talk about, okay, we built it, we want to use it. What do we do to transfer it?
Yep, exactly. So yeah, so when we were talking offline kind of before this, what are the subject matters we can go into? We could go into straight M&A work. I want to sell, I want to exit my business, exit planning and things about, just, kind of straight down the middle of the fairway. We can talk about that all day. But one of the other tacks I'd like to kind of introduce in there is thinking about it, like you just said, looking at it from a multi-generational standpoint, not just selling your business, which every business owner is going to have to do. And I appreciate you covering, the good all the way to the dark side, right? Either a planned exit or an unplanned exit because they happen. But even setting that aside, where does that fit in with your overall lifelong strategy? And that includes generational wealth and building for future generations. How do you think that through? What does that mean? What are some of the things that maybe you haven't thought of that we invite people to do every, multiple times a week when we're talking to business owners? Have you thought about this? Have you looked at this? What does it mean, for the next generation and for your future? And believe me, we've seen all different broad strokes of kind of how business owners see the next generation and what does their business exit mean for that next generation.
Well, let's talk about, okay, you've got it, you're passing it on, you need the financial metrics. What role does debt coverage ratios do in trying to figure out what the company's worth and where it's going and how they benefit the next group?
Awesome. Great question. Great question. So debt coverage ratio really is kind of the unknown, aspect that feeds into a business's valuation. We all know about EBITDA multiples. We do that analysis, and we could talk about this in this conversation, but that's fairly plowed ground for a lot of business owners. But one thing that gets overlooked a lot is, what is it going to mean from a debt coverage ratio standpoint? So you may be in an industry where there are very high multiples for your business, and then when you go to into market and say, all right, I'm ready to start looking at people wanting to buy my company at whatever multiple my industry has. Another thing that is important to look at is what is the debt coverage ratio going to be for the person who buys your company. Now, people ask like, well, why are you talking about debt when someone buying my company? Why don't they just write a check and buy my company for cash? It's just a fact of life that 99% of buyers are going to be using somebody else's money. So I've had this conversation before. Hey, my business is worth $5 million. Why do you keep bringing me buyers who want to get an SBA loan? Why don't you bring me a buyer who has $5 million he could pay for my business? As well, the truth is, a buyer with $5 million in cash is going to buy a $50 million business. So debt coverage ratios come into the equation very early in the process because it does enable us upfront to say, look, is this transaction actually going to close? Because there's going to come a time when all of us as a team, buyer, seller, bankers, attorneys, are going to be standing in front of the underwriting department at the bank or the PE firm providing the funding to say, yes, provide the money for this acquisition to happen, and the business is going to be able to pay back that debt service cost. The debt coverage ratios are going to make sense going forward.
Absolutely. And then, Chris has heard this before, so I apologize, Chris, but you always go to that situation where you go into a company, they're wanting to get prepared for sale. We were introduced to a company a little while back, and they had 3 months of cash left in a fire sale for $6 million. And basically, they were not going to walk away with a lot of money to the owner. They wanted us to handle the QOE, the quality of earnings side, and help them through that sale. Once we got in there, we found that the company had a lot more tools and assets that they could use that they didn't know how to use or what to do with them. And in that process, convince the owner, okay, give me 90 days. I'll find something to bridge your cash so that we don't run out of money and close the doors in December. And we did. So 90 days later, we're going out to get a loan for the company. We put together, now here's the debt coverage factor. We put a loan on that company for about $4 million. And the assets, the cash flow, the inventory, et cetera, allowed us to do that. And, it had issues that we had to deal with, but we put it on there, and it was a CPG company, consumer products good. So we used that money first to automate their plant. Second, we put in EOS, Entrepreneur Operating System, into the company, which is the simplest, best tool for getting into the underbelly of that company, getting into the operations of the company, and finding out who's in the right seat and who's in the wrong seat. So over the next few months, we replaced 5 of their mid-management and senior management members, put the company into automation. We had 3 national contracts they've been trying to sign for over 10 months. We got them signed in the first 90 days. The company had a 500% increase in EBITDA, and we sold the company 15 months later for $26 million. So we went from a $6 million fire sale, same company's out there trying to buy it, knowing it's for sale, kept in touch, and 15 months later, we sold it for $29 million. Now, the buyer of that company, for whatever it's worth, 8 months later, flipped that company to PepsiCo and flipped their money. So, that's how some of those things work. So they came in, they analyzed the company, saw they had a deal, they saw they could find a takeout. And by the time they were in, got all the financing done, they had flipped it, got all of their money back, and made a profit on it. So that's where we like to come in. So Dirk, getting that into discussion, preparing the sale to the open market, restructuring for profit maximization. That's what I just talked about. We went in, we got rid of everything that was nice, kept everything that was need, and turned the company to a different direction. What are your thoughts on that?
That's a great segue, and you covered a bunch of really, really cool things, and just in that short story about that company that you were talking about, and I love stories like that. So one thing that comes to mind, especially when it comes to debt, is psychology. We often joke at the Vant Group, hey, we're glad that we're prior business owners, glad that we have MBAs and finance degrees, but man, we wish we had taken more psychology classes when we were in undergrad and grad school, because there's a tremendous amount of psychology involved in it. And speaking of debt, in terms of this process, so I often talk to business owners and I'll ask them about their company, and they'll find a way to interject, and they're like, oh, and I have no debt. Almost like in their mind, the fact that they have no debt somehow makes their company more valuable. And I have to, keep pointing them back to what you just pointed out. What determines a company's value is really that cash flow, that EBITDA that the business is generating. and debt doesn't come into the picture. Now, obviously it's going to impact their take home, right? Because, most sales are cash free, debt free. If you have debt, it comes out of your proceeds, you got to retire the debt. But taking another look at the debt or lack of debt, is there an opportunity that maybe the current owner missed over the recent years to grab more EBITDA because they were afraid to take debt? And the story you just described is a perfect example. And sometimes sellers, their eyes kind of roll back in their heads when I say, hey, look, the person buying your business is going to take on debt, and it just doesn't resonate. But think about it from this standpoint, right? A professional private equity company or a strategic investor, they know that they can use debt as a tool. Looking at the company that they're looking at now, can we use that debt to leverage and really expand that EBITDA and flip it to PepsiCo later? Like you just described. And another way to look at it, a young private equity person, looking at the cost of debt, whether it's 11% or up to 16% for a mezzanine loan, in their mind, if they can't do better than 11% or 16% per year in terms of value that they're adding, then they should go find a different job, right? In their mind, achieving that kind of return on their own calories, it's a no-brainer. So bringing in debt is absolutely not an issue to them. And I get it. A founder-owned business. You've been running a business. You started it 30 years ago. You had those times when you were putting payroll on your credit card as you're growing the company and barely making it. When you get to where things are stable, man, I don't want to put a lot of debt pressure on it. Just understand that the next generation looking at your business, whether it's your kids or some private equity guy, they're not going to necessarily have that same outlook on debt.
Well, carrying that, one of the other aspects, and we have another company, a related company that we did, they were a transactional company and had been, they'd made 700,000 EBITDA the year we got introduced to the company. Mm-hmm. One of the first things we did was look at, can this transactional company create or have a product that we can push to the internet technology and see if we can get this as a tech-driven company. Mm-hmm. Over the next 12 months, we did that. And we moved that company from being totally, I want this product or I want this service, transaction done. Now I've got to generate new people coming into that, to going out and building a network for referral for tech-driven situations to take that. And I'm going to ask your thoughts on this, but when we were first looking at them, we were probably in a 3 to 5 multiple of that EBITDA. Mm-hmm. By moving that to tech-driven, two things happened. One is we drove revenue. Second, we reduced the cost of obtaining that revenue, the overhead servicing of getting the product out there.
Perfect.
And during that next year, we started gaining the EBITDA, the revenue and the EBITDA down. And then by the second full year, we were pushing that thing into what I'm going to call tech-driven, which now pushes it into an 8 to 11 multiple. Mm-hmm. So we had to get a blend of how much money came in from tech-driven versus transaction-driven. That company, over those 2 years, we took the 700,000 EBITDA to 12 million EBITDA, and their multiple from 3 to 5 to what ended up being a 10.5 mm-hmm. for that sale. Mm-hmm. Share your, now SaaS, you can take that thing 15, 16. So why don't you talk about the multiples, the rule of 40, things of this nature, of how do you build a company, even a small company, that you can take a SaaS product at the multiple or a tech-driven product at the multiple or transactional. Share what your thoughts are on that.
Yeah, no, that's a great point. So one of the things that you touched on is something that we refer to as the cash flow pyramid. And I won't try to draw it with my hands or anything like that, but it's a known factor in in the American business landscape. If you picture a pyramid, and the bottom rung or the bottom row of that pyramid are the mom and pop small businesses, the candy shop on Main Street, doing about $150,000 in EBITDA or discretionary earnings, if you want to call it. The top of the pyramid is the S&P 500. Doing multiple billions of EBITDA. And as you kind of go up that pyramid, the multiples go up with it. If I had a candy store doing $150,000, I went to sell it, I'm basically selling a job. I'm probably looking at a multiple of, call it 1 times, so I could probably sell it $150,000 cash flowing business for probably about $150,000. If I were to sell, the entire company of General Electric, right now, the price earnings ratio in the S&P 500, I think is probably close to, in the 20s. So that's a theoretical multiple of that cash flow. So the bigger your EBITDA gets, the bigger your multiple gets. So just what you described, growing that EBITDA from 750 into the teens of millions, that's obviously going to push their multiple up. Then yes, they went from a transactional company to a tech-driven company, and multiples for different industries, they're different. And especially if you're looking at SaaS, especially if you're looking at tech-driven, multiples will go higher, very quickly. Now, one thing that's going to be haunting that transaction all the way through is the debt coverage ratios, right? So once you get above a 5 times multiple, the cost of servicing the debt to take down a company at more than 5 times the cash flow, the cost of servicing that debt is very quickly going to be get really close to what the cash flow of the company generates. So here comes psychology again. Believe it or not, even people in bank underwriting departments, or the analysts in the back office of a private equity firm or a mezzanine lender, are going to be looking at things like debt coverage ratios. So it's going to be important to overcome whatever psychological hangups they might have in terms of covering the cost of the debt, and what does it mean for the for the future and things of that nature. So yeah, so it's something that is always an issue. It always comes up no matter the size of the transaction.
Well, if you would share a couple of opportunities that the Vant Group, redacted, has gone through to take them from somebody that was absolutely ready to go to market when they got there. And then I want to ask the question to be included in there. How many companies come to you ready to go to market when they make the phone call to you?
Mm-hmm. Okay, I'll do them in reverse. So probably in terms of the ones ready to go to market when they come to us, hey, it's probably about 10%, right? And there's a lot of things that could drive the, okay, I'm not ready, right? And a lot of times it's just really the expectation in terms of someone coming into the process. I have this company that does this. My neighbor across the street sold his business for 10 times his cash flow. I want the same deal. And the companies are nowhere, near any kind of similarity whatsoever. So it's important when you're embarking on the sale process to really have an understanding of what is your company really worth. How is it going to be seen in the marketplace based upon your industry set, your cash flow, comparable transactions, and things of that nature. So whether it's the Vant Group, obviously I think we're the best at providing that valuation work up front. You should get a professional opinion from somebody who's looking at the value of your business, not just based on the assets in it, not just based on the money you put in it, but what really it could sell for. And then oftentimes we'll have that conversation, and then the seller will be like, gee, that's not what I need or not what I expect. Let me go think about it for a few years. And so if you look at our current stable of sellers who are actually in the market, we have listed, we may have had that conversation with them 3 to 5 years ago. There's other things you can do to prepare for sale. We do like a full battery of checking your business's sellability. When was the last time you took a vacation? What the hell does that have to do with the sellability of a business? But if you have a business where you haven't been able to take a vacation for 3 years, either it's not making enough money for you to take a vacation, or the business would fall apart if you weren't there. Well, what are you telling a potential buyer? When you exit, the business is going to fall apart. Because really, when you sell a business, you're not selling really a stable of assets. You're selling the promise of a going concern. It's been a going concern. After you're the new owner, it's going to continue to be a going concern. The value that that the marketplace will establish upon it is kind of how it's doing. So yeah, there's been a ton of stories like that, where all kinds of different industries, industries from we recently sold one. They buy corn from farmers, they bag it up, and it becomes deer corn that goes out to hunting stores and things of that nature. That was a multi-year journey of getting through, understanding what they have, what that seller's needs were, how the marketplace was going to see it, what multiple we thought it was worth. And we had to structure a combination of things, and not just SBA financing, but even conventional loans, to make sure that we were meeting the needs of the bank's underwriting departments, looking at the different categories of assets, managing their risk, and then continued to go forward. And that business went from a almost 80-year-old owner to a young 40-something owner who is ready to take it to the next level and grow it. and it comes, he wasn't afraid to take on that debt because he knew what he could do with the business and has been wildly successful with it.
Well, you touched upon one thing, and why don't you explain the Switzerland effect as well as the concentration issues that you immediately have to look at in looking at a new company to take to market?
Okay, gotcha. So the when you say concentration, you mean like a customer concentration?
Customer or employee or industry or whatever, any kind of concentration to where they're subject to economic hits very quickly by minor changes in that dynamic.
Got it, got it. So yeah, so this is going to sound weird, but we were kind of lucky to test this business that I was just talking about through the COVID years, and by the way, transactions happened during COVID. So I know there are business owners out there that say, well, I can't sell my company because I know you're going to look back over the past few years and we were impacted by COVID. Well, guess what? Everybody was, and deals still happened during COVID. So, in this particular case, with the deer corn, what's going to happen to the deer corn business? And by the way, deer corn is corn that people put out to feed deer so they have a good population to hunt later. That was absolutely unaffected. In fact, it did well during COVID. There was a technical concentration issue because the group that they sold to, it was a majority of their business was to this one company that bought these things, but it went out to a bunch of different stores and different brands out there across the US. Customer concentration is something that buyers will look at, private equity buyers will look at, and then as a potential negative. A bank underwriting department will also look at it as a negative. Some of them have a hard, fast rule that says, hey, if your concentration is over 25% in one customer, we're just not going to do the deal. So then our job is to sometimes shop around for buyers and capital providers where it's not going to be a showstopper issue. And even if it is, to talk them through it, right? Because remember, psychology is always there, even in a, visor wearing propeller head, analyst in a bank. There's a psychological aspect of them too, and we could touch upon it. Another case, had a company that does primarily work for the Defense Department. And it's like, oh my gosh, 80% of your sales are to the Army. And then walking the bankers through the aspect of it's like, well, yeah, it's the U.S. Army, but there's multiple different divisions within the Army that do this purchasing that have absolutely independent decision-making capabilities. So it's not 80%, it's 5 or 6 different departments that are independently, so we're able to talk through concentration issues and things of that nature. So and then you asked about the Switzerland effect. So what do you mean by the Switzerland effect?
Isolation, being able to stand on your own and et cetera.
Oh, got it. Well, man, I mean, Switzerland isn't doing a great job of being isolated lately, because it's really hard. It's hard to stay isolated. You really can't. Things are going on around you, and you can choose to react to them, or not, right? So we see that with business owners. We see that, in the owners themselves isolating themselves within their business. I manage all of the customer relationships. The employees come to me when they have questions about how to do things. And that negatively impacts your ability to sell. So if I'm going to buy your business and all the customers know Paul by name, what's that going to mean? If there's no employee processes or manuals where people know where to find the answers to their questions, they go into your office 8 times a day with a question. Are they going to be coming into my office when I buy your business? And man, I don't know anything,
Well, following on that, you mentioned it briefly earlier, but the other company I was talking about, we convinced the owner of the company to resign as CEO and become chairman of the board.
Yeah.
And promote a person in the CEO position, not only give that person the authority, but needless to say, that chairman had pretty tight reins on it. But we were able to start breaking away the psychology, if you want to use the word, psychology in that company as to how it was being run, what was the quality of the company that they were buying, and the continuance after it was sold. So that was one of the items. The other item is it was an international company. So we made the decision to change corporate offices to Galway, Ireland. Upon sale, we had 12% tax rate instead of the US tax rate. Of course, you had to do the transfer pricing right and et cetera, but it reduced the tax effect of that by several $1 million.
Mhm.
So all of that had to be taken into account years before the actual sale.
Yep.
That's
Yeah.
part of the point here, is that every company needs to be planning to be for sale every day. Start looking and getting advice as to what can I do if I want to be here
Mhm.
in 2 years or here in a year and a half or whatever. And I'm covering a subject that I'm really looking for you to come back and share what kind of things the Vant company has done. You mentioned the corn was a multi-year deal. Why
Mhm.
don't you go out on how the Vant company helps companies prepare when they come in unprepared?
Yep, absolutely. So one of the things we always remind people, because when we talk to people that sometimes some embarrassment will come across, like, hey, I know I want to sell my company. I've looked on the internet, I've talked to people, but man, I just don't understand the sale process and how it works. The first thing I'll tell people is like, look, don't feel bad. Every business owner is going to have to go through an exit. But the truth of the fact is, those who have sold a business have typically only done it once in their lifetime. We do it all the time. So don't feel bad if you don't understand the sale process and it's new to you. All right. So that's why we're here, to help you with that. And then, every client that comes to us, even if somebody who says, hey, I have a fire sale situation, I want to sell my business, we're going to do some analysis to say, look, this is what you're going to expect in the marketplace. Some firms have different business models. Hey, you bring your business, you want me to list it, and we hope for the best. Great. We're not. We're going to do that analysis up front and say, here's what you can expect in a sale. Are you okay with this? Even before we ask them to sign a contract, right? We want to make sure that they know what they can expect in the marketplace. And then through that process of them learning what their business is worth in the marketplace today, a tremendous amount of information is imparted to them. Here's what's helping your valuation. Here are the things that are hurting your valuation. Here are things that you could do differently. And here's how the math works for your company at your size range. People often take that like, oh, I see how it works. And then they go back and they make they make changes to their business. Things like you just talked about. How do I take myself out of the day-to-day operation of the business to where, like you mentioned, going from the CEO to the chairman of the board, to where the business is able to run itself. So I can actually take some vacations from time to time. I've seen people make those changes over and over again in their business. And sometimes we shoot ourselves in the foot, right? Because let's face it, part of the reason that people come to us, or in some cases when people come to us like, hey, Vant Group, I want to sell my business because it's driving me crazy. It's like, okay, well, you need to go do some things that's going to make your business more transferable to somebody else. In other words, they'll be successful after they sell it. And guess what? When you do those things where your troops are actually stepping up and doing sales and things of that nature, the business isn't driving you crazy anymore. So literally, there's been dozens of times when people are like, hey, I don't want to sell my company anymore. It's like, okay, well, you're still going to have to exit the company someday. Make sure that you come back to us when you do. So
Exactly. We've
yeah,
got
those
a client right now that we've gone through the processes, trying to get it ready. And I said, okay. And he came back to us with a suggestion. I said, okay, we're going to do this. He's going to take a 2-month sabbatical.
nice.
He's going to take off from the company. I have no clue what he's going to do. But the process in this particular case is he's not going to answer emails to anybody in the company, not going to be able to be available by phone.
Yikes.
He knows he has to have a line of communication for the what ifs.
Mm-hmm.
So he's actually
Okay,
engaged
good.
us to be the, shall we say, the common ground to evaluate what's going on, see if we can help him first.
Yep.
But second, if it's something he really has to be involved in, a document he really has to sign or something of that nature, that he will, through his wife, take our contact
Okay.
and deal with the issue. Now, there's a lot of prep going into that and a lot of planning and job assignments and reassignments and responsibilities, but it's making him go through that exercise before the company's sold to try to ensure that it is an ongoing concern without him, just as you
Ab-
mentioned earlier.
absolutely.
If everything comes to him, the value of that company went down 30, 40, 50% right out of the chute from a buyer.
Mm-hmm. Yeah, exactly. And the other way it manifests is, that's a good yes, no question for buyers too. They may be interested when they see the financials, but then when they find out that, they just they just disengage and disappear, you know. So you'll see where, man, we had 20 buyers and they just all fell away for some reason. Well,
Well, as you know, recently we did a convergence summit here in Dallas, and we had 12 speakers for that summit. And we went from the gauntlet, everything from chief outsiders for marketing to Fortium Group for technology to HR Catalyst for HRM HR. And we had Alex out there. One of the things he said in that meeting, and I want to bring this back around for the to be remembered by anybody on this group, and that is the success rate of the company. I'm not going to say it because I've heard it before, but I'm going to let you take the glory for the comment here. How does the Vant compare themselves to the market in their production?
Yep, you bet. So, there's just different approaches to the business model, right? So there literally are M&A advisors out there that will take anybody, throw them on their website and hope for the best. That happens throughout the industry. And on an industry basis, that's successful 38% of the time. You know, so 38% of the time people list their business with a M&A advisory group, and 38% of the time a successful sale happens. Our average is 90%. So by the time we take a client, we've done that work up front before we ask them to sign a contract. We make sure that we vetted them. Are they really ready to sell? Is their business really ready? And are they prepared for what is the marketplace is going to yield in terms of a value? So that's how we're able to get that 90% success rate. You can call it cheating if you want. Hey, we're only going to take clients who are really ready to sell. Well, how's that cheating, right? You know, because, and then the other thing, the other metric we use is that when we give somebody that opinion, that expectation of value, we're 97% accurate. You know, how do we, you know, how are we able to do that? It's like, well, you know, we have the experience, we have access to the data, we're good at what we do. We break down in very deep detail, not just from a financial standpoint, but what's actually going on in the company to see what the financial performance is and what the marketplace has said through previous transactions, what that business is worth. And then the other thing that we do is we look at it through the lens of how is a banker or a mezzanine lender, how are they going to look at the cash flow and the ability to service debt? And are they going to do and fund this transaction? And very often before we even go into market with the listing, we've already talked to someone who is willing to provide the financing. Sometimes we'll even put a letter from them in the marketing package to say, look, you know, Mr. Banker or Miss Banker, if we find a buyer for this, will you provide the funding? And if they say yes, then we know that we're ready to go to market. So when we find a buyer, we can immediately connect them. And, you know, that funding process is a huge leg in that transaction tent, and, you know, to make sure that, you know, that it's going to close. And that's how we're able to get to that 97% accuracy in doing it. So.
And as I shared with you at the start of the call, when we were getting prepared here, last week, our company, C-Suite Support, was contacted by an investment banking company that we work with here in town to do a quality of earnings for them to prepare for the sale. And in that process of discussion, it came out, we got all the documents, came out, and the company that did the evaluation just happened to be the Vant Group. Had no idea, wasn't solicited from there, but it was the Vant Group. Well, the investment banking firm said, well, you know, we got their evaluation, and quite honestly, we think it's probably very aggressive. And he said came out at 11-time multiple, and they're putting the company at a $61 million market price. He said, we're trying to convince our client, the seller, that that's pretty aggressive. Don't be quite expecting that. Yesterday, I had the conversation with them. We're down to 5 out of 20 LOIs received. We're down to evaluation of the final 5. Of those final 5, they range, in this particular case, they range from a low of around 50 million to 60 million. So you're going to hit, if the 60 million buyer is the buyer, ironically, you're going to be in your 97% factor, even when the investment banking firm thought it was probably more in the 40 million range. So yeah, I think it was just very coincidental. And at any rate, we're moving in on that deal. He's bringing us in to try to do some work with them. So I wanted to tell you that this is not fluff, guys. Everybody,
exactly right. Yeah,
this is not fluff. They actually do that, and one of the things, and we'll get this information to you, and I'm going to ask Wendy Watson if she can step in here for a second, because she's wanting to talk to you and get connected with you about a potential operation. So no need to go into detail, no company things for us on this call, but I want to get the two of you together and see what we can do to help things go. And that's part of the reason why we do these things. So Wendy, you're muted, so come on in.
Hi, guys. This is my first time in here.
Hey, Woody, mine too.
Not sure where to start, but it's actually my parents. They are looking to retire in the next 2 to 3 years. They have an auto transport business. My dad has a 5-car hauler that he drives up and down the state of California, and he transports vehicles, right?
Mhm.
So he's on the road 6 days a week, and they don't know where to start or what to do. I found somebody that is in this world, but they don't have a clue about the transportation industry.
Mhm.
So they really couldn't help them. And I love all the ideas that you're throwing out there, as far as, because he is he's the business, and my mom does all the operations.
Mhm. Yeah, see it all the time.
Right. I mean, small business, that's the way that it looks. So, but they would have no idea on where to start, on how to work themselves out of it
Mhm.
so that it would be marketable to a buyer.
Mhm.
So is there somebody that they can speak to, or is willing to speak to them, to at least get them going in the right direction, or give them some strategies?
Mhm. Yeah, so just that last question first. I mean, we have those conversations with people all the time, and I'd be happy, to talk to your mom and dad, anytime, and we do. Like, earlier in the call, I mentioned our current clients we may have talked to 3 years before, in exactly, this type of situation, right? So, but just a couple ideas, just thinking through, kind of where they are now. So your parents are going to exit the business someday, right? And they're your parents, so I don't want to go too dark, but not all of us live
It's okay.
forever.
I'm
Yeah.
good.
So someday your dad's not going to be able to drive the truck, right?
He
Anymore.
needs 2 knee replacements at this point.
Yeah, man.
He's got to get out one way or the other.
Well, hopefully the truck's an automatic and he's not having to hit a clutch too with the knees, Anyway, so you didn't want that kind of detail, right? So anyway, so just thinking through, just outside the box, right? So there are car transportation companies where the owners are not driving the vehicles. They have drivers who are driving the vehicles, right? And so if your dad could get out of the cab of that truck, somebody they trust can be in the cab of the truck driving the truck and doing those deliveries. Okay, that's a great first start. That's a huge step in making that business a sellable business, right? And then step 2, we were talking about debt before. Your parents, their generation is very debt averse, right? It's like, well, if they have a few years, before they want to sell, and they are open to financing another truck and another driver, theoretically they could double their business, right? And remember, I was talking about that cash flow pyramid before. If they can double their EBITDA, not only, let's say it was the same multiple, well, the business value just went up, but their multiple is likely going to go up. And so there's a difference between somebody selling a car hauling business with 1 truck and somebody selling a car hauling business with 10 trucks that don't just do California, but man, there's a lot of people leaving California, right? And they're very good at planning routes from California to Texas and to New York and things of that nature. So there are things that they could do that may involve some kind of risk, but if you can gently remind them, and maybe just you guys already talked about it, there's going to be a business exit someday, and what does that exit look like, and what does it mean for them? Are they going to be able to retire and enjoy their their golden years together, or is he going to be in the cab of the truck until something happens?
Well, I'd like, Wendy, if you would, if you want to go in the chat and send Dirk your contact information, and let you guys take this offline. I think it's a great subject, a great question, and kind of opens the door for ideas here. And let you guys go into the more granular and what are the next steps type thing. But this is exactly what you need to do. 2 to 3 years before you're wanting to sell, you need good advice. You need estate advice. You need, not only how much can I sell it for, but how can I protect the taxes? One of the things we do with our clients is try to get them to transfer their ownership into living trust. It's got a single taxation trigger with that. It's taxed when it goes into the trust, but then the living trust goes on forever and it's not taxed. So just simple little things that need to be taken care of during this operational 2 to 3 year period.
Mhm.
So with that, Bob Norton,
Paul,
I'm sorry, go ahead, Dirk.
yeah, while Paul's coming on, do you mind if I pivot, kind of back to something earlier in the conversation? So we
Sure.
talked about generational stuff, right? So I know we're going down the middle of the fairway on M&A stuff, which I'm happy to talk about all the time, right? But one thing that people don't often think about is the generational aspect of it. So Wendy, when your parents started that business, however long ago, their plan may have been like, hey, we want to grow this company that the kids take over someday, or we want to build, a huge amount of wealth that we could transfer to the next generation. So sometimes that gets overlooked, right? So just, I want people to think about in situations where kids are working in the business, sometimes those kids can be the buyer, for the business, right? And then I don't have any data behind this, but anecdotally, we see multi-generational businesses. We see, one generation has the business, they sell it, the kids get an inheritance from it or not. We see situations where the kids work in the business and then the parents are like, well, yeah, they could take over the business. I guess I'll just give it to them. Well, but then you don't have any capital for Paul or anybody else to work with for your retirement or legacy planning. Consider selling the business to the kids. Like, well, that sounds like really mercenary. Why would I sell the business to the kids? Like, well, just at a high level, you can bring outside money into the family situation through an SBA loan or for a larger transaction of private equity money that you can retire with. It's like, well, yeah, but then the kids have the debt. Well, so remember, somebody younger coming into business ownership may not be as debt averse because they may want to go buy 2 more car hauling vehicles and grow the business and do very well with it. And then the anecdotal thing is about the 3rd generation. When the 3rd generation, takes the reins of a family founded business, that's when we see businesses really take off and pop and pivot. Just as a side note, I got my MBA from Wake Forest University. I wanted to be in manufacturing. I did a summer internship at the Thomas Built School Bus Company in High Point, North Carolina. You've seen Thomas school buses, the yellow school buses, just like you imagine. Well, that company was a family-owned business that started in the 1800s making stagecoaches. And it's been run by a member of the Thomas family ever since then. They make the kids go off and do other things and banking and work at other companies before they come back. But it's a multi-million-dollar company when I was working there. So.
All right, Bob.
Hi, Bob Norton. I'm a serial entrepreneur that sold 4 businesses and helped many others accelerate their growth and value.
Yeah, Bob, you got a lot of Air Force stuff in the background there. Is there a connection there?
Well, I'm a pilot and a sailor and a serial hobbyist, so I've got a lot of things. Not a military guy, no.
I got my mom's eyes, so I was a cop in the Air Force. So,
I tend to follow the military technology and use some of the military metaphors and in business and Sun Tzu up to the more current weapons, So my question is kind of around framing and understanding what the bottom size of the market is today, and probably relevant to Wendy. I've been involved in transactions up to 780 million, which was the largest company Amazon bought at the time, and down to little Amazon sellers that sell for they got $1 million in revenue and sell for a fraction of that, with no real moat or sustainable competitive advantage. So my question is, where's the market? It used to be that you didn't have a market until 5 million EBITDA, and I think that's a decade old saw, but I've heard it's come down. I don't see many transactions on that lower level. And I also have a scenario I'd like to get your opinion on. I've got a client that is a very famous author who probably everyone here would recognize, who's in his 80s, ready for retirement, and he wants to sell the business, but he really doesn't have recurring revenue. And so in a situation like that, where you've got a famous brand, but not necessarily recurring revenue and a bit of a business plan, is there a market for a company like that? Or is it really below what will create, a market and a reasonable offer that's worth someone retiring on.
Okay, got it. Yeah, you actually asked a couple questions in there. So let's talk about the $5 million, $1 million thing. So where is the market? So the Vant Group, we're in an interesting situation because we're in the business broker space, the small and Main Street, mom and pop type businesses. And we straddle into the lower edge of the middle market, the private equity, realm and things of that nature. We can do transactions from $1 million up to 50 million. Can we do bigger transactions than that? Absolutely. But we often lose those because if you got a $50 million business, you got a board and they're going to be like, who the heck is the Vant Group? Go use somebody bigger, right? So, but we've been very involved in kind of that a tertiary boundary between the small and Main Street space and the lower middle market. And you're right. Several years ago, a private equity company wouldn't look at anybody doing less than $5 million in EBITDA. Now we've been in a almost a decade period where there are more buyers out there than sellers. It's very difficult to find a good quality, appropriately priced business. And private equity companies have been beating the bushes for years. And so we've seen them go below that $5 million EBITDA entry point down to now $1 million in EBITDA is probably their entry point because those over $5 million waters, use nautical analogy, were very heavily fished. And so now they're, over the recent years, they've been coming into that range between $1 million in EBITDA and $5 million in EBITDA. So they're looking, further south in terms of EBITDA. And then remember in that pyramid I described earlier, there's a lot more businesses out there doing $1 million in EBITDA than there are businesses out there doing $5 million in EBITDA. So there's absolutely a market for businesses really doing any kind of level of EBITDA. Now, back to the author and the recurring revenue. So so recurring revenue can be a thing, right? You only get revenue when there's a book, right? And there's some recurring, there's online sales of audiobooks and there's some recurring revenue. But really kind of the core issue with that situation is remember when you're selling a business, you're selling the promise of a going concern. And so if that author is the sole creator of those works and the generator of the revenue and the EBITDA, and that author isn't there anymore, that promise of a continued going concern really isn't there anymore. So that's something that would have to be addressed for that, call it a business enterprise, if you will, for that to be a transferable, sellable business enterprise.
And
Yeah, that was
along
my
with that, Dirk, I mentioned at the onset of this call that we currently are working with an investment banking firm that was strictly working with public companies, over 100 companies currently. They have moved downstream to the private companies because the bigger companies, due to the economic issues going on right now, are going downstream. Just following exactly what you just said, they've gone from I don't want to look at unless 5 million downstream, which is forcing the smaller boutique firms like the one we're talking about to go down to the private, and not only to the private, but down to maybe we can sell this for 5 million. Maybe we can sell it for 2 million. So Bob, I think just to follow on to what Dirk is saying, at this point, if you've got a company that has an ongoing ability, no different than what we were talking about with Wendy a few minutes ago, if it can be structured to where the owner can walk away and the business can continue to be an ongoing business very profitably and have opportunity for growth, there's something out there and somebody that may be interested in it. So I'm going to pull off of that and stop.
Thank you, gentlemen.
Yeah, you bet.
All right, Chris Govan, you mentioned that you've got a couple of questions.
Yeah, sure. No, great discussion, Dirk. Thanks so much. So I'm often involved working with companies, and one of the things I hear a lot of, both between the buyer and the seller, the buyer is sort of buying what is today in the business, current state. The seller, as you mentioned, is selling a going concern. So there's a future component to that. There's a give up. So kind of two questions. On the seller side, are there ways intuitively to think what you're giving up versus what you're getting? Meaning, if a multiple is a 6, am I giving up 4 years worth of income? And that's essentially it. On the buy side, I guess, are there mechanisms that you're seeing today more prevalent than others? For example, earnouts, rollover equity, things like that help align buyer and seller. So really 2 parts if you want to jump onto those.
No, yeah, absolutely. Great Great, great segue there, Chris. So yes, so you know, when you're selling a business, you know, the price is going to be established kind of, you know, in terms of how you're doing today. You know, you're getting a multiple of EBITDA, but that's today's, you know, EBITDA, that's today's multiple. That's what the marketplace is going to say the business is worth. And in the seller's mind, like, well, gee whiz, you know, someone's going to come in here. I'm only going to get, you know, 4 years of income. You know, someone's going to come in here, they're going to grow it. It's going to be worth a lot more. I don't want to give that up. Well, plan A for not giving that up is we'll keep the business. You know, you go grow it. You go get those higher, you know, earnings and things of that nature, and then look at a sale later. It's like, well, I don't necessarily want to do that, or, you know, I have health issues or what have you. A buyer looking at your business, yes, they're going to look at it from the standpoint of the going concern and what's it worth today and things of that nature. That's how they're going to establish value. That's how the bankers are going to establish value. But the buyer looking at it is like, okay, is there opportunity for it to grow? Right. And if they see that growth prospect and that growth opportunity, it's difficult to get that growth potential to impact the current price today, but it's critical in getting the buyer to, yes, I want to do this transaction, right? And then so oftentimes, you know, where we come into the picture is like, okay, we know what the bank's going to say it's worth today. I think seller agrees that there's potential for growth. Buyer agrees there's potential for growth. There's probably, you know, future growth, so the business could be worth more. How do we skin that cat? You know, if the bank or the limited partners in a private equity fund are focused on, hey, here's how it's doing today, this is all we're going to loan, then yes, an earnout absolutely can be a mechanism for that. You know, as the business grows, the seller gets to participate in it more, hold back equity. Sometimes that comes with more seller participation in the operating and running of the business going forward, and sometimes that's a good fit for sellers, and sometimes it's not. You know, because what people often don't think about is you go from being, you know, the woman in charge of the business to where now you're going to be mid-level management, and not everyone, you know, can make that transition, but those are absolutely tools that can be used. Ironically, we see that a lot in private equity companies who come to us looking at deals that we're marketing, or just looking on their own for deals. Like, hey, we have this cool idea, you know, we want to find an entrepreneur-owned business. You know, we'll buy a chunk of it, you know, we'll ask them to work there, and then, you know, they work with us for 3 years, and then when we exit, you know, the second bite of the apple is going to be bigger than that first one. And doesn't it sound great? And I think what a lot of private equity guys and gals are missing from the psychology standpoint is not every seller is motivated, you know, to want to do that piece of it. But yeah, there are mechanisms, you know, for doing that. And, you know, I talk about, you know, SBA small deals. The SBA recently lightened up on some of the rules to allow owners to continue to maintain a piece of equity to participate in the growth of the business. It used to be they had to do a clean exit, you know, within a year. So.
Okay, and then a quick one. So thanks for answering that. I know that could potentially be a long answer to that one. So you
yeah, exactly
on that one. So thank you. The next one quickly. So if you're quarterbacking the deal, the deal process, at what point do you typically bring in tax people, legal people, any additional experts or advisors that you might need as part of the process?
Man, that's a great question. Yeah, so the sooner the better, and the quality of those advisors are hugely important, right? So, you know, one of the psychology questions we ask sellers are, what are you going to do after you sell the business? And if they don't have a solid plan, we're going to slow walk it until they think about it. You know, have you contemplated what it means for you to now be unemployed? You know, although maybe have a chunk of change, you know, do you and your spouse get along? You know, those types of things. And then, you know, where does it fit into your retirement? You know, do you have a financial planner? Because I'm not a financial planner who's done the math for you that says, okay, here's what you're going to take home, and here's what it means for your, you know, your legacy and your plans and things of that nature. Have you thought through the tax implications? Because we're not tax experts either. So getting people involved. Now, there's going to be attorneys involved, and the right attorney is important. You know, an attorney who understands transactions is far superior than the guy who handled your brother's divorce, you know, 4 years ago. That's not the attorney you need on a transaction. So, but yeah, we're used to quarterbacking and making people mad all throughout. So,
great, thank you.
I'm going to ask a couple of quick questions. Uncle Dan, you asked, had a question for us. Want you to jump in here, and in light of time, we have about 3 minutes left.
No problem. Just a quick question. Do you, when you are, doing the calculations on the EBITDA, do you take into consideration the R&D tax credit in that valuation?
Yeah. So if if someone has done things to kind of accelerate depreciation, and it's, kind of related to what you're talking about, we will normalize EBITDA based on what's going to be, on a go forward basis. So, any assets, whether it's R&D, any intangibles, any fixed assets, those are likely going to be reset as a result of a change in ownership and things of that nature. But that's kind of mostly where we see it. Does that address your question in terms of the
Yeah.
tax credit? Okay, I got you.
Absolutely.
All right, any last questions before we close for this session? If not, I'm sorry, Bob, go ahead.
I wanted to compliment Dirk on making sure the owner is ready to part with their baby. I've got some horror stories on that one where one of my clients had a $60 million offer and spent about a year in due diligence, and the PE company had made an offer and spent $1 million on legal fees, and the guy still walked away at the end.
Yeah, we try to catch those up front.
Yeah, and then one of the things, and I'll share this right now, no one's expressed this thought, but if a transaction goes past 90 days, the likelihood of that transaction not going through goes up exponentially every 30 days thereafter. PE firms very seldom have the patience to go that long, and it gets deal fatigue. So that's one of the reasons that you need someone like Dirk, like us, to make sure that you're ready. We actually go in to help you get ready. Dirk finds people like us to help that company get ready. And when Dirk gets it, if he's not ready, he doesn't want to go to market to get someone signed up just to have them work, spend money, and et cetera, and then walk the deal 90 days later because they weren't ready. So that's the whole premise here, is run your company like it's for sale today, get your estate things in place, get your company that you're going to work with to give you advice from today forward. You may not sell it for 10 years. You may not give it to your kids for 3 years, whatever the situation is. But I guarantee you, if you run it like it's for sale every day, you're going to watch your expenses, you're going to watch what you're dealing with, and you're going to look for things to not only expand the business, but how you expand the business. So with that, Dirk, I want to tell you, thank you so very much for joining us today, being part of it. Tell Alex hello for me. Tell him that I'm ready to start doing some more quality of earnings with him. So let's just get stuff going, and hopefully we'll get this $60 million sale that he did the evaluation done here quickly.
I hope so too. Awesome. Thanks, everybody.
All right. You guys take care. Appreciate it.